For years, people have looked at their retirement plans and their IRAs and developed strategies to be able to transfer them to the next generation. Not a spouse, but their kids, their grandkids. Well, all of that ended with this cute little thing called the Secure Act. What happened to the Stretch IRA? Well, it went away. We'll break that down for you on Consider This Program today. Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
I'm Brett Spangler.
We're happy to have you along, Brett. Hey, Brett is a CPA. He's part of the FEG team. And we are always happy to have his tax knowledge and guidance. He is definitely one of those resources that we go to a lot inside of the Financial Enhancement Group. So I'm gonna let him run with this just to a degree. You've probably heard that the Stretch IRA is no more. So let's talk about real quickly, what was the Stretch IRA?
So the Stretch IRA previously was non-spouse inherited IRAs, could be essentially stretched over the lifetime of the beneficiary, and that went away with the Secure Act.
So was the Stretch ever in the tax code?
No, not.
No, it was never ever in there, but everybody talked about it,
Yep.
and the plan was very, very. I mean, it was very instrumental. Remember, when you have an IRA or a 401k, you have essentially two different types of beneficiaries: a spouse and a non-spouse. Right? Really, really complex. They talk about whether they're eligible beneficiaries or those kind of things, or some of the more technical terms that you use. But your spouse could always roll their IRA or your 401k or your IRA into theirs, and they don't have to take the money out any sooner than they would normally have to take it based on their age. But with the Stretch, the whole point was that when something happened to myself and to Barb, our daughters would be able to take the money out over their life expectancy. So, yes, you can be 28, 29 years old and have a required minimum distribution. That's what used to happen. If you have an inherited IRA before 2020 and somebody had passed away, you actually have a required minimum distribution you're eligible to take. What happened after 2020?
After 2020, they shortened that time and said you have 10 years now to take distributions of those funds, and so which can have a dramatic impact on tax situation.
So is there still a required minimum distribution?
No, you have 10. You just have to have that money out within a 10-year period.
So instead of taking it every year,
Right.
they can wait until the end of time,
Yep.
right? And I will just tell you, after doing this for 33 years, you typically have one of two events, right? You either have kids who cash the check the moment they can cash the check, or you have ones that will try to let the money grow because there is still a bias that believes tax deferral is a good thing, right? So if Brett and I agree to die on time, right? That's my fancy way of saying 84 and a half. If we agree to die on time, in theory, our kids are going to be 60, right? 55, 60 years old. They're probably going to be in their highest income earning years. And suddenly they're going to inherit all of the retirement money that I didn't spend, and they're going to have to put it on their tax return, right?
That's correct.
So this is a fancy way for saying the IRS, I think it was $17 billion that they believe, by eliminating the Stretch, that they added to the tax coffers. Now, $17 billion sounds like a lot of money until you're starting to throw around $1 and $2 trillion infrastructure programs. And it's kind of like, why did we wreck American families, for $17 billion if we're going to turn around and do something, as crazy as we're doing it in other places? And no hate mail. It's not me saying we don't need roads and bridges. I get it. We just have to be paying a little bit more attention to the financial world. So what would be a strategy? What would you recommend, right? If something happened to me and Kaylee came in to see you and she was going to have to take my 401k out over the next 10 years, what would you tell her to do?
So I'd say it's critical that we have a game plan and actually look at what anticipated marginal rates and have a deliberative strategy of when this money's going to come out, not just, like you said, wait till the end and just dump the whole amount on your tax return at one time. So that would be my recommendation, is let's get a game plan pulled together.
So one of the things that we look for every year is what we call income variability. So we'll send out the Financial Enhancement Group mails out a package to all of our families. Brett, when he does the tax returns, sends you an organizer for you to report and tell your story. We send out a tax planning one, usually that first week in October. And what we're looking for is income variability, right? And so this may very well be what you're going to see with kids in the coming decades, right? Until they change this rule back, if they ever did. But what you're going to see is people take a year off to take money out of the IRA, right, or out of the 401k at a lower bracket. So think sabbaticals. For those of you that are in the not-for-profit entity, that's one of the strategies. Look for periods of time like COVID, right, where you have the ability to give it. I heard somebody say that you could not do qualified charitable distributions out of an IRA the other day, and out of one of these accounts. I will tell you that is inaccurate. Yeah. You just have to be 70 and a half. Yeah. Right? So it's not whether or not it was an inherited IRA or not an inherited IRA. You can still do the QCD, but you do have to be over 70 and a half years old. So when we're looking at this, and this is one of those things, and Brad, I don't know how much you've gotten to it in your career, but on this show, I've talked to people for years about all beneficiaries not being equal.
Correct.
Right? So you've got a pile of money, and if you did everything like we try to encourage people to do, you've got some tax diversification that's built, right? You've got some money that's tax deferred. You've got some money that is Roth driven, right? And you've got some money that is that's you've already paid taxes on. So you've got 3 buckets of money, and you may want to treat your kids equally, right? I mean, I get that, but not all beneficiaries are the same, right? So how we go about leaving that money behind, who the beneficiary is of one account versus the other becomes very, very, very critical, in my opinion, in terms of making sure that we get the biggest bang for the buck, right? So you get those 3 piles of money. What happens to the money that's after taxes in my account? If something happens to me and Kaylee and Kendra inherit the money, what happens?
So putting any kind of state tax aside, it would just transfer to them, and there's no tax consequence to them.
Why is there no tax consequence?
There's because you've already paid tax on it. That money's there, unless there's, like I said, a state tax. That money there, there's no tax consequence. It's a gift to the heirs, and there's no tax consequence to them.
So there's a thing called a step up in basis.
Yep.
You want to explain what that is?
Yes. So stepped up in basis means that upon the date of death, the value of that asset steps up to the current value, not the value of the deceased. So, for instance, the deceased could have purchased an asset years ago and have a very low basis, but it steps up to the basis of the value upon the date of death.
And this is one of those things you're going to hear a lot of people talk about this year, because that probably the last 5 or 6 administrations, the Democratic side of the Senate and of Congress has tried to eliminate the step up in basis. I still don't think they'll get it done. I think it's much more complex than what people believe that it is, but it is an issue that is out there. So if I give you a stock and I'm alive, right? So I give Kaylee a stock that's appreciated. Right. What's her basis?
So her basis is whatever the value. When you're alive, it would be whatever your basis was. She would step in your place and take your basis.
So it transfers.
That's correct.
And at death, however,
it steps up to the fair market value upon the date of death.
So again, this creates a lot of confusion. Benjamin Franklin used to say that most men die at 25. They just wait for their bodies to catch up. And what he was trying to get you to understand was that most people don't relearn stuff as they get older, right? And what used to happen in the tax code is people would hold on to stocks forever, right? Because they didn't want to pay the commissions. Well, there's no commissions to buy and sell stocks anymore. They didn't want to pay the taxes, and they wanted their kids to get a step up in basis, if you will, when they died. Makes all the sense in the world. But, remember when we talked about, if you're in the 12% tax bracket, there is no long-term capital gains tax, right? So, let's say, and Kaylee, don't get excited about this, but let's say Kaylee shows up at the house and she needs a gift, right? I can gift her cash. I can gift her out of my IRA.
You can gift her Not out of your IRA, but I was going to the next step. Appreciated stock.
There you go. So you can never give, including a spouse, you can never give money out of your IRA or your 401k to another human. Mm-hmm. A judge can order that through a quadro if you're going through a divorce or something like that. But other than that, that has to transfer at death, right? But I could give her cash or I could give her stock.
That's correct.
So if I gave her stock and I'm still alive, right, I'm still able to fog a mirror, as they say, right, then her basis is going to be my basis.
That's correct.
But then she's going to sell it at her tax bracket.
Correct.
Right? And here's one of those other things that confuses people. The tax nature goes with the asset. So not just the basis, but let's say I've owned this stock for 20 years and I make that gift to Kaylee or Kendra, right? And they take it and sell it the next day. There are people who believe, well, that's now a short-term capital gain. They've only owned it for a day. That's not the case. Right. It is a long-term capital gain. Very, very, very important to understand from a planning perspective in terms of how you look at this and what is going on. So anyhow, the tax code can be quite confusing. It's why we have CPAs, CFPs, EAs, CFAs, CMTs, and all these other cute little credentials that are running around in the office team. It's easy to get confused, when they come up with the rules. And just in the last 3 years, we watched the Tax Cut and Job Act, right? And at the end of 17, then we watched the Secure Act at the end of 19, and then we watched the CARES Act, in March of 2020, thanks to good old COVID. So it's very, very easy for people to become confused with this stuff. If you are, do not feel bad nor feel like the Lone Ranger. It is challenging, but you do need to have competent people that can help you walk through it. Give us a call at 800-928-4001 or go to yourlifeafterwork.com. We're happy to sit down with you and have a next steps meeting. We'll give you things to consider today, things you're going to want to consider in the future, and if we choose to partner together, what FEG will do for you, and we'll put it into writing. If you want to do this on your own, that is your business. But if you're looking for a fiduciary, that's our business. Give us a call, 800-928-4001.